The world believed inflation was finally fading into history.
Markets were preparing for stability, for relief, for a new cycle. Until a single region shifted the balance of the entire system.
What followed was not a collapse, but a surge in uncertainty.
Oil did not just rise, it surged with force and uncertainty. Supply did not collapse, but the system began to tighten under pressure. Risk premiums surged as insurance costs and transport uncertainty climbed rapidly.
The first visible impact appeared where energy meets everyday life.
Industries began to absorb the shock as costs rose faster than production.
Inflation returned, not gradually, but with sudden and visible force.
It spread across sectors, linking energy, industry, and consumer demand. No economy remained isolated from the shock moving through the system. Corporate margins began to compress as costs rose faster than revenue.
Equity markets reacted violently as investors began to reprice risk everywhere.
Energy stocks surged, while airlines, logistics, and manufacturing began to falter.
Bond yields swung unpredictably as markets weighed inflation against slowing growth.
Currencies shifted violently as the dollar gained and emerging markets felt the strain. Volatility became the dominant force, reshaping every market, from stocks to bonds. Investors began to reassess every position as the threat of inflation spread. Some sectors thrived, while others buckled under the pressure of rising costs. Bond yields fluctuated wildly as traders wrestled with uncertainty in both growth and inflation. Currencies shifted dramatically, the dollar surged, and emerging markets felt intense strain. Volatility dominated, forcing every asset class to reprice under uncertainty. Inflation began to ripple beyond energy, affecting wages and consumer expectations.
Companies began feeling the squeeze as costs climbed faster than revenues.
Price increases rippled across industries, linking energy, transport, and manufacturing costs.
Central banks watched closely, aware that delayed action could worsen the crisis.
Investors began repricing risk across every market, from equities to commodities.
Some equities soared, others crashed, revealing the uneven impact of rising costs.
Bond yields oscillated wildly as traders wrestled with uncertainty in both inflation and growth.
Currencies shifted sharply, the dollar strengthened, and emerging markets felt intense pressure.
Volatility became the dominant force, forcing every asset to reprice under uncertainty.
Central banks faced an impossible choice between controlling inflation and sustaining growth.
Tightening risked slowing economies further, while inaction risked runaway inflation.
Markets held their breath as policy choices could make or break stability.
Expectations of higher inflation began to crystallize, limiting policy flexibility.
Anxiety spread across markets, forcing rapid reassessment of risk everywhere.
Companies struggled as rising costs began to outpace revenues across the board.
Inflation rippled through wages and prices, creating pressure far beyond energy costs. Rising costs interconnected sectors, from energy to transport and manufacturing.
Economic growth began to falter as costs and uncertainty weighed on spending and investment.
Central banks monitored these cascading effects, aware that delay could intensify the crisis.
Equities plunged as investors fled from risk, seeking safety wherever possible. Bond markets oscillated violently as yields spiked under renewed inflation fears. Currencies shifted dramatically. The dollar surged while emerging markets buckled. Volatility dominated, forcing every asset class to reprice under uncertainty. Markets reassessed everything simultaneously as systemic stress became undeniable.
Companies across sectors faced unprecedented margin compression as costs surged relentlessly.
Rising prices forced wages and supplier costs higher, embedding inflation deeper into the system.
Inflation spread like a chain reaction, linking energy, transport, and manufacturing costs.
Economic growth faltered as rising costs and uncertainty suppressed spending and investment.
Central banks carefully observed cascading effects, knowing delays could worsen systemic risk.
Oil prices remained unstable, continuing to ripple through global financial markets. Markets showed signs of fatigue, struggling to react to persistent shocks. Institutions rebalanced portfolios, shifting capital to manage heightened risk. After sudden swings, a temporary calm settled, but tension lingered everywhere. Markets slowly adjusted, adapting to a new reality of persistent oil and inflation shocks. Capital began to flow differently as global markets reassessed risk and value.
The stabilization is holding, but the systemic risk remains elevated. We need to adjust the equity exposure accordingly.
Energy costs settled temporarily, but inflationary pressure remained embedded.
Investors reshaped portfolios to reflect this new normal of persistent uncertainty.
This is WARFLATION, a new regime where conflict and inflation redefine market behavior.
Markets gradually adjusted, finding temporary balance after relentless turbulence.
Inflation persisted at high levels, reminding markets that risk had not fully subsided.
Central banks kept rates high, signaling caution in the face of persistent inflation.
Even as volatility eased slightly, uncertainty remained the dominant factor.
Markets showed tentative stability, but the shadow of warflation still loomed. The world's financial systems had adapted, but the memory of volatility lingered.
WARFLATION became a permanent reality, reshaping how markets and policy interact.
Energy costs and inflation would continue to define strategic decisions worldwide.
Yes. Markets and institutions remained vigilant, ready for the next shock that could disrupt balance.
This was not the end, but the beginning of a new financial reality called WARFLATION.